Hey guys, you're listening to the Tasha Labs podcast. So I haven't posted an episode for a while because I've been traveling. Well, actually, I went to a week-long silent meditation retreat in California, and that was wonderful. But I'm super tired right now, and I just got back. I know you're there thinking, Tasha, that it doesn't make sense at all. You are supposed to. It's a meditation retreat, right? You're supposed to sit there and do nothing all day long. How can you be tired? But here's the thing, when you are on a meditation retreat, you meditate like for hours and hours, and then you basically, you get up and you try to concentrate, and you try to concentrate all day long, and that's actually a lot of effort. So after a week, I'm like exhausted, but that's the good kind of exhaustion. It's like you take your brain to the gym almost, right? So afterwards, you just feel like the world is in like technicolor, super vivid, and your mind is so quiet. There's so much less noise, so much less mind chatter there, and the world just seems like a much better place, and the time slows down. Anyway, if you don't have a regular meditation practice, I highly recommend, because that's to me one of the most effective and costless hacks for your health and well-being. But before we turn this into a health podcast, let's look at what we're going to talk about today. So before I went traveling, I wrote this article basically talking about the big problems that I see today in the Web3 and crypto space. Not like a problem in the sense like you necessarily have to be gripey about it, but it's like just challenges both on the technical and adoption level that I see will be, if solved, would actually lead to the next quantum leap in the mainstream adoption of crypto space. But because of these bottlenecks, because of these constraints, we are sort of on a in the flat tier, I would say, in terms of technology adoption journey. Because if you think of how technologies are being adopted, they don't go in a straight line, right? It's not like the internet has 500 million users today, and then it goes like 5% linearly every year until it reaches 1 billion and 2 billion, and so on and so forth. It goes in a kind of stepwise fashion. It's like climbing a stairs. There's a breakthrough in technology or in some trigger of adoption, and you kind of jump one staircase, and then things kind of flatten out when that initial trigger or initial momentum sort of dies down. So you kind of get into that flat part of the ladder or stairs, if you will, until something else happens, some other breakthroughs happen, or another or some major bottlenecks get resolved and lead to next stage of innovation and adoption. And that's how I see adoption of a lot of things go, including technology. So to me, there are, if you look at the crypto space today, right? So we had a last crypto cycle where people discovered that DeFi and NFT are wonderful. And then you had major adoption waves, and maybe some like play to earn, move to earn stuff, or gaming stuff. You had adoption waves motivated by those things. But those things kind of, after a while, that those initial ideas, they got played over and over again. And at the end of the cycle is basically you see a bunch of copycat projects, right? So and then the adoption slows down. And if you look at the space today, I would say if everywhere you look, you see a lot of issues and a lot of problems that inevitably happen when you have a sort of a immature technology, right? And whatever application level is also not very not in a very mature stage of development of the industry. And then you have all sorts of scaling issues, usability issues, and things like that. So all of those things, it becomes like cumulative bottlenecks for the next stage adoption. So the way I see it is like projects that are working on those big problems, that or those problems, if solved, will actually open the door to the next stage adoption for the industry as a whole. Those would be like some of the most interesting projects to look at, right? So but in order to, so that's sort of a framework I'm thinking about this issue. So we're in a bear market. If you're looking at projects, where do you look? I think one way to think about this is you want to look at projects that are actually solving big problems for the space. So and also this is a good time to look, right? So because we're in a bear market and the token prices are coming down, and associatedly it kind of negatively affected evaluations of new projects, right? So if you're looking to do kind of angel VC type of investments, or some kind of initial token sales and type of thing, I think this is a good period to look for that type of thing. Instead of focusing on liquid tokens, you want to focus maybe more on those, kind of initial offering type of projects right now. So I'm not saying like prices won't go down more. I think it will. But compared to 6 months ago or 12 months ago, I think we're in a much better place to actually scout for new projects. And I started looking more into angel investment type of deals, while last year to the beginning of this year I was mostly in liquid tokens. Okay, so what are some of the big issues that I'm looking at? So I'm just gonna briefly go over some of the issues that I talked about in the article. I listed 8 problems, but in fact there are so many of them. But I ran out of space because I didn't want it to be a very long article. So I listed 8 of them, and I'll just briefly go through some of it, and then we will look at some of the questions associated with the article. Okay, so first of all, issues related to DeFi. So I think so we had this huge innovation that we call DeFi, right? It's permissionless access of alternative financial structure that does not rely on, or at least supposedly rely much less on any centralized authority. So that's a great thing, and I wrote a lot about the advantages, the competitive advantages of DeFi, and the business model, how that's different and lead to faster pace of innovation and so on and so forth. And that's all well and good. But the truth is, today, most of the DeFi products, they're sort of very, very inaccessible to any kind of mainstream audience because they are seriously just crappy. It's really bad user experience to use. So that is I would say the number one problem I see with DeFi. First of all, with the DEXs, decentralized exchanges, is that you have so many issues when you try to execute a transaction. So for example, you get impermanent loss if you try to provide liquidity to the AMM pools, and you get very large slippage when you try to execute any kind of not even transaction with size, right? Just like a normal transactions, if it's a smaller market cap token, you have problems with large slippage. And then you get MEV attacks. You get sandwich attacks, and they're like bots trying to look at your transactions in the mempool, which is kind of a waiting room for transactions to be executed, right? So, and then people try to hijack your transactions so that you get a worse price. And then also, a lot of times the transaction executions are not reliable, but that's more related to the layer 1, layer 2 infrastructure, right? A lot of times, I don't know if you experience this, but I experience this a lot. Both, I would say, on almost every chain. that I used. Maybe some of the newer chains are a little bit better, but from Ethereum to Solana to Avalanche near Polygon, I think I've had this problem in all of those on all of those chains. It's just like your transactions get dropped. Why does it get dropped? You don't know. There's no error message. It's just like the MetaMask shows you, your transaction got dropped. It didn't execute for whatever reason. And if you want to capture a kind of a trading opportunity, and that happens, it's super, super frustrating, right? So how can you even trust this network if you cannot do kind of these simple things correctly, right? So, and also there's no transaction control. What I mean is, like in traditional centralized exchanges, in like your stock brokerage account, for example, that trading platform, you can execute stop order, limit order, you can delay execution, schedule execution, right? That type of thing. With DeFi, it's much less possible, because you have this blockchain infrastructure which does not allow any kind of asynchronous behavior, right? So you basically everything that you need to get done related to a transaction, it needs to be done within a one block of the blockchain. So it needs to be concentrated in a very short time frame. So unless you introduce some kind of centralized databases with some kind of like a scheduling jobs, otherwise with blockchain alone, with smart contract alone, you don't really get to execute any kind of it's very hard to execute any kind of like an asynchronous transaction, asynchronous operational logic, right? So that just creates a lot of limitation in terms of what decentralized exchanges have been able to do, and that has led to, I would say, contributed to the poor UX that we see in the DEX space. And also, you do not have any kind of well, actually you have some, but it's very underdeveloped, I would say, indexing and tracking and analytics in the token space, in the token universe, the asset universe that can be transacted on chain. So obviously you have DEX screener, you have if you go to any kind of DEX like Uniswap or Sushi or anything, you have like a dashboard, you show your token prices and price history and so on. But they're all like really preliminary, right? So it's much less comprehensive and much less flexible compared to any kind of screening or analytics tool you can find in traditional financial products such as equity market or bond market, right? So I can talk more about this because I saw a question, at least a couple questions like people were asking related to that. So that means it just like any kind of transaction active, unless you just do it like a token swap once in a while, then that's no problem. But if this is something that you do regularly, right, as a I would say professional investor or as an institutional investor, which that's where a lot of liquidity is being handled, right? It's just like you just like very, very hard to actually use a DEX, right? And also talking about analytics, you have the nice thing about DEXs is like they're permissionless, right? So you can set up like a AMM pool for any tokens that you want. You can provide liquidity with however little liquidity you can have to get started with. So you can have thousands, tens of thousands of tokens, token pools being traded on the platform like Uniswap. The thing is, you don't know where they are. You don't know. Well, you know where they are, but you kind of don't, because again, the kind of analytical tools kind of lacking, right? And also these liquidity pools, so they're so segmented. You can have a liquidity pool vis-a-vis ETH on Uniswap for this XYZ token. You can have another same pool on another DEX, and then you have another pool of XYZ Z token vis-a-vis USDC, and all those like segmented liquidities. In the DeFi space, there's no like analytics to tell you what's actually the liquidity situation, like in a comprehensive manner related to a specific token, or so it's kind of very hard to discover, very hard to screen. But so that's the number one thing I see related to the DEX space is you don't have all these like basically UI UX issues that we just went over. There's very, very, very lacking, right? So again, the flip side is that if those are the problems that prevents adoption, then you pay attention to projects that aim to solve those problems, right? So at least to me, I think the next stage you see more projects that will combine some kind of centralized databases or approaches of traditional, TradFi platforms with some kind of DEX business model to solve some of the scaling problems. So, and a second issue I see is really this is related to the money markets on chain, right? So the lending and borrowing, the DeFi banks, so to speak. Right now, we all know there's pretty much no other use cases for on-chain lending except for you borrow coins in order to speculate further on coins, right? So that is not that's not the mainstream use case for borrowing and lending in real life, as we know. But then we're going. So for DeFi to actually expand to more mainstream, you have to somehow incorporate other type of use cases for the lending and borrowing, other types of users and other types of distribution channels, besides just allowing degens to play with tokens online. So so there are projects that are working on these things. So they tend to be the kind of a relatively slower moving innovations, but they are out there, and some of them can be interesting for the next cycle, whenever that's going to be. So, and also if you look at the NFT space, one issue that I see, like on the basic, very fundamental level, is that if you want to use NFT to represent any kind of asset off-chain, you have to have a way to reliably map a NFT to a off-chain asset, a house, a car, or something, right? So there is currently no way to do that. And there's actually not even a reliable way to map a NFT to a asset that is on-chain. In the asset that is in the digital space, not on-chain. So this is something like when I did, like for example, when I did the, I had created NFT from a destroyed diamond, right? So when I did that, a bunch of people were saying, okay, how do we know you actually, crushed this diamond and created this NFT, and you didn't create a second one for the same diamond, right? So it's very hard for me to prove that, right? So I try to prove it by documenting with some videos and articles, but you only go so far in that regard, and that is definitely not something that is scalable, right? So there are a lot of chatters in terms of future use cases for NFT. If you want this space to expand, you have to have like more use cases and also more serious use cases. Serious meaning you have to be able to represent assets that are actually of pretty significant value, right? So, but in order to do that, you have to make sure these basic technical kinks are being solved. Otherwise, there's no way to actually, for people to entrust a system with assets of serious value, right? So for example, if you are if let's say we want to create a system to use NFTs to represent asset like a real estate asset ownerships, that's like a really hard to be taken seriously if you actually have to rely on some clunky mechanism of another centralized authority to kind of guarantee that this NFT is being pointed to this specific house, right? So so if you look at the traditional property ownership structure, you have all these centralized parties. You have all these you have like the property registries run by the government that is hosting the database of all the real estate properties in a specific geographical area, right? And then that serves as a centralized authority, like a centralized source of truth. And if you buy and sell a house, you also need to get like a lot of different service providers involved, including things like you have to if you sell a house, for example, you have to go through this closing process, which involves basically a bunch of lawyers and other professionals that try to verify the ownership history of this property in order to make sure the ownership is actually clear for sale, right? So that entire process, you can say, in the traditional financial like asset exchange space is quite costly. So today, does blockchain, this NFT can potentially reduce those costs? Right now, we can't, because you still have these fundamental technology issues that have not been solved. If I actually need a centralized party if I need a authority, or I need a government, or I need an agency to actually guarantee that this NFT is being associated with that house, how is it that different from the property registry hosted in the government database, right? So it involves the same level, almost the same level of cost, if not more. So and also this problem is not even solved for digital assets. You can point an NFT to any picture you want. It's just a URL of an image, right? So and then some people say, okay, now you have newer blockchains like when I posted this, for example, a bunch of people, I think from Cardano community, was saying, okay, you can actually store the image on chain, so you can make sure this NFT is actually corresponding to this image, right? But that still doesn't solve the problem, because it costs nothing to produce an image. To produce a JPEG costs nothing, right? I can copy paste a JPEG and create another NFT, and I can store both images on chain. What prevent me from doing that? And so the thing is, and then people will tell you, okay, you can look at the timestamp. You can look at when is this image being created, and then you can figure out which one is the authentic one, supposedly. But the thing is, then you're putting the burden on the purchaser or on the buyer to actually figure out if there is a alternative version of the same NFT out there in the universe, right? So you're kind of putting the burden on the user to, in fact, serving to incur the cost of essentially the same function as a title company. What does title company do? Search the property ownership history, or search any information related to property to make sure this is one and unique, and it's available to actually for sale, and you, the owner, actually have all the legal rights to sell this asset, and so on and so forth. So if I'm a buyer of a NFT, even just a JPEG on chain, and if I see this in the marketplace, right? How am I supposed to know that whether there is a identical NFT image out there somewhere else? I don't. It's very hard for me to know. if I want to know that information, it's not like impossible, right? But it's costly. It costs me time and energy and effort in order to do that. So that's all like the transaction costs adding onto a asset transaction process involving NFT, right? So this is no big deal if we're just talking about JPEGs, which is most of them not worth anything, and most of the JPEG NFTs are going to zero anyway. So at the end of the day, nobody cares. But the thing is, if we're talking about expanding the use case of NFTs to represent, again, assets of actually serious value, then it becomes a problem, right? And it becomes a pretty huge problem because it will imply a huge transaction cost to actually using NFT to represent to represent assets of significant value. Okay, so so you have fundamental problems like that, and also with regard to NFTs, you have right now the infrastructure, the tooling for NFT storage and display and verification. It's all at a very, very beginning stage. So it's very hard to display an NFT. It's very hard to, use it for anything. And, if you want to use it to prove a membership, in order to get some, membership benefits, or any kind of like associating NFT ownership with any kind of activities. It's kind of clunky process, right? So, but again, we are very, very early. So these are the problems. But the good news is that you will have projects that will strive to solve those problems, and that will become your future investment opportunities, right? So and what are some of the other issues that I mentioned in the article? We have, like, obviously the blockchains themselves. We have a lot of room to improve in terms of cost and performance, and then once you have all the blockchain ecosystems, you need cross-chain operations. You need bridges. You need cross-chain messaging protocols to actually connect them, right? To actually allow people to travel from one chain to another, to allow assets to be sent back and forth. And so all those things like cross-chain traffic, traffic channels need to step up, right? And we are still like very early in that as well. So and then going to the application layer, we are only at the beginning stage. So any kind of real world integration with the crypto world. So I wrote about utility tokens before. I think they will be big in the next cycle. You are already seeing them happening. There's a project that I just wrote about called Sweatcoin, which is fascinating. I'm actually probably going to invite their founders to talk about it, to talk about how they bootstrap their traction on this podcast in the future. So really looking forward to that. But any kind of like a real world integration, real world use cases, like connecting crypto world with the real economy, we are really only starting in that. So I think a few weeks ago, you probably saw the news that the largest e-commerce platform, Mercado Libre in South America, they are going to have their own utility token, which is essentially a loyalty token, right? So if you haven't read that news, now you know. Okay, so you may wonder, okay, what's it's not a big deal, right? It's just a loyalty coin, and businesses have loyalty programs all the time, right? But again, there is a key difference here when this becomes a tradable asset on chain, when it has a secondary market liquidity in a open, permissionless, programmable network. that really changes the game night and day from a token that is being constrained in a company's database in a walled garden. So if you don't if you don't yet see the significance here, I'll just give you some like potential implications. Okay, like Mercado Libre, for example, they have this utility token which is going to be a ERC20 or something. Maybe they will be on a newer chain or have some kind of bridging mechanism to bridge to some faster chains. I hope they do, because otherwise it'd be super slow and painful to trade. But anyway, because they are such a huge platform and this token is borderless, if this token gets into enough wallets, for example, and keep in mind, this is a company that has gazillion users in multiple countries, right? I think they are launching this in Brazil, but they are present in almost all the Latin American countries. So it's going to be spread out. Even if they don't open to other countries, keep in mind this is like a fungible token on chain, right? So anybody can set up a liquidity pool, you can trade it, and no matter where you are. So it's very hard to restrict it to a specific geography once it becomes a tradable token in a open platform like a public blockchain. So what will happen is, if you have enough users, enough people have this token in their wallet, okay? So it becomes, and keep in mind, this is like also a loyalty token, meaning you can actually use this to redeem goods and services. Not, I don't think Mercado Libre has service, but to redeem merchandises. Okay, let's say. So that's what part of what gives the token kind of the backing from the real economy, right? So supposedly, let's say this essentially, this essentially becomes the currency of the Mercado Libre economy, right? So, and it's a multinational economy. So eventually what you may end up is, if this token gets big enough, it becomes a de facto cross-country medium of exchange, right? And I can very easily imagine people start transacting using this token in and out of Mercado Libre. And especially given that the monetary policy traditionally in Latin American countries, countries like Argentina, Venezuela, monetary policy is very badly run. So the currency value is very unstable, and the trust for local fiat currency is very low. Okay? In that scenario, it's not hard to imagine that if you have a medium of exchange that is cross-country, that's easy to use, that you can actually be used to redeem products on a international platform that has a lot of adoption, it will become a competitor to the fiat currencies in the countries where the fiat currency is not so stable, right? So then it becomes and also it becomes de facto means of cross-border transactions, even though that token has no intention. It wasn't its goal to become a medium exchange or a cross-border transaction tool or remittance tool, and so on and so forth. And I hope you see the beauty and the magic in this. Okay, the beauty and magic of a open, permissionless, and programmable, financial network. And once a token gets onto this network, and once it gets into enough adoption, a lot of other things can happen. Like this token can start to serve a lot of other purposes, much beyond its original intention, right? So Mercado Libre would not, of course, their intention is not to. They're not publishing issuing this token to compete with national currencies, right? That's not their intention. They just want more customers, more revenues, more customer loyalty. But the implications of these tokens on chain, well, once it integrate with real economy, can be huge, right? So, and we are only starting to see at the beginning stage of that. Okay, so that's about the article. I will link the article. You can go check it out if you want. So let's look at some of the questions. Okay, question from Michael R. The biggest problem with most crypto investments is value accrual doesn't flow to token holders, so the project can be successful, but that is independent of the token's success. Well, I don't entirely agree. I think there is some truth in that. Obviously, you want the token value to be associated with the revenue to be tied to the adoption of the project or the revenue of the project, right? So that make that token more like a semi-equity. So I think that's the framework of thought that you will use if you see the token as a semi-equity. But there can be many types of tokens, including meme tokens, right? Why does Dogecoin have value? Dogecoin has no revenue at all. How do you gauge the performance? The performance of the project, right? So you can think of there are different frameworks to look at the token, look at different tokens. But I'm not saying I'm opposing to what he said. I think what he has said is it's obviously correct in a lot of senses. But I do think the biggest problem is actually not enough projects have viable product in the crypto space. I think if you actually have viable product that people actually want to pay for, and you have like a genuine adoption that is not driven by reflexive financial cycles, tokenomics is like a second order problem. So once you fix that product market fit problem, tokenomics is like a second order problem that you can fix later if the product starts to get traction. Okay. Next question from Marco. Can you unpack a bit more about he's talking about this NFT one-to-one mapping thing. Are you saying the NFT image itself should also be stored on chain as opposed to a hyperlink to a Web2 storage being stored off chain? Well, I already talked about this, right? It's not just that. Even if you have a image stored on chain, that still doesn't solve the problem, because it's cheap to create image. It's cheap to copy image. You can create another image and then publish another NFT and store both on chain. And so that does not solve the asset mapping issue, even for the digital assets. Not even to mention the real world assets, right? Next question from Serial. I think most of the issues. I think for most of the issues, for the DeFi UX issues to be solved, we will need more scalability on the infrastructure side, throughputs for layer ones, for example. Yes, that's right. You definitely need more performant blockchains or ledger databases, whatever, even if they're not blockchains. But still, that some of the issues is inherent in the DeFi operating model itself. For example, the AMM model, which is it's different from the traditional asset swaps or asset exchanges, which is more of an order book model. With AMMs, you have like two pools of assets, liquidities already sitting there, and you just like exchanging between those two pools of assets, right? So that kind of AMMs, the benefit is like it's always, the liquidity is already there, right? So you don't need to wait for matching orders on the other side in order to execute an order, and also anybody can create those. So it facilitates the creation of liquidity and trading for a long tail of assets that may not be very popular or traded much, right? But the downside is it's really not that scalable. So there are projects that are trying to get around that by, again, try to operate DeFi more in a more similar to in the traditional financial markets. For example, there are token exchanges that try to operate from RFQ model, request for quote, which is instead of using a liquidity pools, you kind of just, when you have the order coming in to buy and sell a token, you kind of query the liquidity providers, and then ask them for quotes, for price quotes. So that can potentially be like cheaper operations and solve some of the like slippage problems. But still, that is limited to large tokens that have a lot of volumes. You cannot expect the large liquidity providers to cover all the tokens, all the long tail assets in the world, right? So, but that's just an example of people are trying to innovate, sort of like combining the DeFi business model with more of traditional financial assets, traditional financial exchanges. Okay. So next question was Retro R. Interested in your thoughts on whether you would recommend investing in the coins, in the tokens of these projects versus looking for ways to invest in equity where that's possible, noting that it's not possible in many cases. So this is actually quite an interesting question, because I would say, the boundary between tokens and equities is it's going to becoming, I would say, more and more blurred as time goes on, especially as tokens kind of inherit more values from the capture more value added created by the enterprise or company or project. What do I mean by that? So let's take the example of let's take the example of a utility token. Okay, so let's say this company has issued a token in order to bootstrap user growth, in order to give user incentive to use their product. Assuming their product is good, it's sticky, and people actually want to use, so it's a viable product. Okay, so the company is actually growing. So, but with token, if you read some of the things I wrote about utility tokens, it's really a mechanism, kind of, it's a growth mechanism for companies to solve their initial growth funding problem, to fund their growth with token instead of funding growth with cash. So, which is cheaper for company, but they do have to give up their future revenues, right? In order to compensate the token holders, either in the form of exchanging for future products and services, in the case of liquidity tokens, or in many cases, they may decide to further incentivize the token holders. They may decide to actually share some of the revenues with the token holders, or to actually buy back tokens with their future revenues. So then if I hold, so if you go like, for example, if you buy stuff on Mercado Libre, and then you earn token while you do that, okay? And then Mercado Libre says, okay, to incentivize you to hold tokens, we're going to allow people to stake tokens and earn some yields, let's say, which is like common practice in the crypto space, right? So where does that yield come from? In the worst case, it comes from new token emissions. But nowadays, like investors get like smarter, so you kind of like you don't want to do that anymore, right? Or at least you don't want to. If you don't want your yields to come predominantly from new token emissions, so you want to tell people, okay, our yields will come from our future revenue. So we will, use our future revenue to actually buy the token to give them to you as yields. Okay, so then you're essentially, you as a user, as a customer of the company and token holder, you're essentially the company is essentially sharing the revenue with you, sharing its future added value with you, right? And so how is that different from like a shareholder in the traditional sense? Because what does it mean to be a shareholder? If you own the shares of a company, what do you actually own? Theoretically, you own you own the claim to the future profits of the company. Besides other things like voting and so on and so forth, which you don't really get to do much, or not that really that relevant to like a smaller investors, right? But let's say theoretically you own a share of the company's profit streams in the future, okay? And theoretically the company works for its shareholders because the company try to maximize profits and give those profits to you, the shareholder, right? So and the profits given to shareholder, they may manifest in the form of a dividend, which is kind of thinking of as another form of yield, right? Or it comes in the form of, for example, stock buyback. You have extra cash flow today. Okay, we will buy back our stocks, and that should shrink the circulating supply, the floating supply of the stock, and then help the price to go up, and you benefit as a shareholder. So all of these different ways is like companies working for its shareholder, right? But now, once you have token, what happens? You before the company reaches the profit, before the profit is being calculated, right? Company, like part of the company's income, like a revenue. Sorry, if I use income, it's like kind of confusing, but like the company's sales, the revenue, the cash flow the company gets, right? That company will use some of that to buy back its tokens, or to give yields to token holders. So what does that mean? You are essentially claiming a share of the company's value added. Now you can argue how much share goes to shareholders, how much, what percentage of that value added goes to shareholder, what percentage of that value added goes to token holders. So that, it probably depends, it probably differs company by company, right? So, but my point is you can start to see that even though the token holders are not called owners of the company, even though shareholders are traditionally owners of the company, but in like a de facto, in a realistic sense, the two really start to merge together, and they both take a slice of the value added created by the company eventually. Okay, so this is still like a pretty much is an evolving space. So what this kind of governance company governance regime eventually evolve into, I don't know, right? But you can start to see some of these dynamics emerge, and this is really quite significant, okay? Because the significance of this, okay, in the corporate governance sense, is like in the past 50 years, or maybe I don't know, past 100 years, ever since the concept of company or corporation was created, there have been a lot of both theoretical and practical discussions. There's sociological and legal discussions in terms of what a company is for. What is the purpose of a company, right? So, the majority of the consensus, at least in the more traditional classic opinion, is to say the company's purpose is to serve its shareholders. I'm sure you've heard about this 1,000 times, right? So it's kind of a commonly held opinion that company's purpose is to serve shareholders. And so but then that's also also the cause of a lot of cynicism in the business world or in the corporate space, that you hear people talk about, the evil corporations, and all they're after is profit, or they're just like after the money, or so on and so forth. I don't think those are fair. I don't think most of those are fair kind of gripes against corporations, because it's like literally the corporation's purpose is to share its shareholders, it's to maximize profits for shareholders, okay? So it's not to maximize something for customers or for vendors or for whoever not relevant to the company. Okay. So yes, it serves its customers, but it serves its customers for the purpose of making money, right? And then, of course, you hear a lot of corporations say in their mission statement, right? We are we emphasize our social responsibility. We serve our customers. That's our number one priority, and we serve our employees. Blah 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 blah. Most of the time, that's just lip service. Okay, so because fundamentally, at the end of the day, the corporation's incentive is to create profit for shareholders. That's its fundamental goal. Okay, that is embedded in the structure of the corporation, and when you have that kind of structure, people's incentive goes along with it, no matter what they say on paper or in their mission statement, right? And that creates a lot of social incoherence, or whatever you call it, cynicism regarding corporations. Now, if how is that related to what we've been talking about? It's highly related, because now you think of if the corporation's mandate, if the value sharing of the corporation goes beyond shareholders now it's incorporating its customers or its users or whoever interact with the corporation. You can be a customer, and you use the platform's product, and the platform wants to the company wants to incentivize you to use this product, so it gives you a token, and in order to incentivize you to hold the token, it has to give you some benefit beyond just having some digits in your digital wallet, right? So it has to entice you to say, okay, this token has real value. Where does that real value come from? It comes from our revenues. In the future, we're going to buy back the token. We're going to give you yields, and so on and so forth. So things we just talked about, right? So all of those things it just basically allow the customers or whoever contribute values to get the company going, to get the company to grow, to get the company to get to the next stage, to generate a profit, would actually share some of the fruit of their contribution, right? So then you become instead of maximizing the values for shareholders, which is only the shareholders only have claim on the bottom line, which is the profit, right? Now it has to maximize all of the things. It actually might have to maximize values it can generate for the token holder as well, right? So then you becomes as you broaden the you broaden the stakeholder base for any corporation. It becomes more and more not strictly co-ops, but becomes much wider. It benefits, the value gets distributed to a much wider set of society. right? So then you will see the social relationship, you will see the social discourse, and the economic discourse regarding corporations will change because of that. All right. So it may sound a little bit far-fetching to some of you, but I think that's it's just something very real and very tangible and very easy to see. Okay. So but that's a kind of a kind of very long discussion. So, but basically, I'm very optimistic to, you know, tokenization actually becomes like a positive sum game for society at large in the long run, despite the, um, you know, the Ponzi's, the frauds, the um, uh, rug pulls, or the whatever going on in the short term, which, you know, inevitably happens when you have a explosive, explosively growing like new technology and adoption process. Okay, so that's all for today. I will talk to you next time.